Paul, show our viewer at home the difference between real and fake due diligence in research.
Okay, guys, first, what is fake due diligence? We encounter this all the time when people tell us you didn't do due diligence, or we hear it about there out there. First off, due diligence is not going to Google and typing in the company's ticker symbol and seeing what the news is on the company currently. That is not due diligence. Is that a component potentially? Absolutely. But don't mask reading articles about the company as doing full due diligence in the company. 2, analyst ratings. Guys, I don't trust an analyst as far as I can throw them. Mm-hmm. Are there good analysts out there? Absolutely. But in general, the masses of analysts are going to be just as wrong because they have career risk, just like most people out there. They're going to give ratings because the stock is up, and they're going to write sells because the stock is down. That is not fundamental investing. That is not due diligence. Number 3, your friends and family giving you advice. Please, Lord above, who I love so much. Yes. If your friends and family give you advice, if you're going to take it, write me a check. Yes. I will keep it in my bank account for a long time, and I'll give it back to you in 5 years when you've learned your lesson. It is the worst place to get financial advice. The absolute worst. I have had so many arguments with family members saying, what, you're not going to take advice? No, I'm not, because you're stupid. Uh-oh. Well, Paul, I'm really smart. I have this degree. I don't care. You don't understand investing. Mm-hmm. Number 4, liking the company and their product is extremely different than owning the stock and liking the stock. Mm-hmm. Fundamentals are driven by what the company is doing. The stock price is going to be driven by people liking the company. Those are separate things completely. Don't mask your love for iPads as a reason to go buy Apple. Does that mean Apple's overpriced? No. But don't have your love for the company. If you love Ferraris, don't go out and buy Ferrari stock. That's not the reason to buy Ferrari stock. You want to buy it based on fundamentals, and is the stock price selling for less than intrinsic value? And the final one, and the one that aggravates me the most, there are very few YouTubers, I can count them on one hand, that have a real process. And unfortunately, they're not the big ones. The big ones do not have a process. They got big on one stock, they got big on one video, and they had to make a career out of making videos. So they're going to say whatever they need to say to get your attention to listen to them. While we look stupid for a while, they're going to look smart. But at the end of the day, if that is your due diligence, that is a problem because they're no smarter than you. They have no process, and that's the scary part.
So, Paul, you've been investing for 20 years. You have $100 million in assets, real estate, stocks. How do you do research on companies?
This did not happen by a fluke. I start with the numbers first and foremost. We created our software here for that reason. I wanted to be able to efficiently look at numbers and see if it first fell in the wheelhouse. Guys, there are 10,000 stocks out there. My time is limited. I have to be able to build a screener to screen out the garbage stocks first. That way I can focus on the ones that garner the most attention. That is what matters to me most. If you don't do it that way, somebody's basically asking you, hey, do you want to buy a car? You say, sure, and you buy whatever car they give you. Well, it depends. Are you selling me a Ferrari for a Chevy price? Are you selling me a Chevy for a Ferrari price? There's no difference with that. So our 8-pillar process that I created and created the software for is what I start with. So take a company like Apple, Seth.
I love it.
And you love Apple. Why? Because it's your joke. What do you have at home?
Yeah, like I said, I have 17 iPads. I have 3 iPhones. I mean, I just love it. I used to not even drink the Kool-Aid, but I'm full board now.
Absolutely. And Seth's 3 phones are for drug deals, yes, his family, and his girlfriend.
Yeah,
Those are his 3 cell
one of the
phones.
burners for sure. Yeah.
Yeah. So first thing I do, pillar number 1, I want the 5-year PE under 22.5.
Why is this important?
This is important because it's going to show growth in the company, but also not overpaying for the growth. Okay. The 5-year PE on Apple is 39.23. That is high. Does that mean I don't buy? Not necessarily. If the company's going to grow 100% per year for the next 5 years, I will gladly pay that number. But Apple is very large. The chances of them growing very fast is very tough. Pillar number 2, I want the 5-year return on invested capital greater than 9%. This is their ability to make money on the money that's invested in the business and that's generated for the business. Check this out, guys. 31.7%.
You want it over 9?
I want it over 9. This is over 3 times more than what I want. Apple does an incredible job of reinvesting the money within the business and making profit on that. Pillar number 3, I want revenue growth. Simple. I don't care if it's $1 revenue growth. I just want to see, is there revenue growth? I go to the income statement. 5 years ago, $230 billion. Last year, $365 billion. That is a check mark. Pillar number 4, I want net income growth over the last 5 years.
This is
Scroll down.
Profit.
This is our profit. Net income profit, same thing. Scroll down a little bit. $48.3 billion to $94.7 billion. Check mark there.
Wow. Shares outstanding is pillar number 5, Paul.
Now, pillar number 5 is our shares outstanding. If you're new to our channel, I talk about this as a silent killer. When companies are issuing shares and diluting you as an owner, I want to see that number going down. So I go here and I actually go to the end of the 6th year, which is the beginning of the 5th year, 21.88 billion shares outstanding, and currently 16.7. So they are buying shares back. Now,
over the past decade, they've bought back 35% of their shares, Paul. This is $448 billion they've bought back.
So this is a company that generates tons and tons of cash. And when you generate that much cash, how the heck do you invest it? Well, you don't. You reward your shareholders through dividends and share buybacks. And that's what Apple's doing. Pillar number 6. We want to see if their long-term liabilities can be supported by their free cash flow. So go back to our main page. We look at their 5-year average free cash flow, $72.3 billion. I multiply it by 5. That's $361.5 billion. So I want their long-term liabilities to be under $360 billion. So I go to the balance sheet and I scroll all the way to the bottom. Total long-term liabilities, 162. It's less than half that. Jesus Christ.
What does this mean in terms of their debt?
So what this means is if they were to replicate the last 5 years of free cash flow and take all their cash flow and pay off all their long-term debts, they could do it in under 2.5 years. Guys, can you pay off all your debts with your free cash flow in under 2.5 years? Your car, your house, your student loans, credit cards, everything. That's very hard. And this huge company can do it. That says to me this company's going to stick around for a while because debt is the biggest killer of companies when times get tough.
You got a new message there in your chat.
I got a new message.
Pillar number 7 is free cash flow.
Free cash flow growth. Very simple. I go to the cash flow statement, I scroll down, and your favorite Uncle Paul has added this line here because cash flow is cash from operations less your capital expenditures. You can do one of 5 things with it. You can buy back shares, pay dividends, pay down debt, reinvest in yourself, and make acquisitions. So here, 5 years ago, they did $51.7 billion. Last year, $93 billion. Check mark there. And the final metric, like PE, we want a price to free cash flow. So we take their average of the last 5 years, 68.2, and multiply it by 20. And that comes out to $1.36 trillion. What's the actual market cap of Apple? The actual market cap of Apple is $2.6 trillion.
Oh boy.
Yeah. So this screams overpriced. And guys, if you can't do all that math, guess what? The software does it for you.
Yeah, I don't want to do that math. That's hard.
So this is one of our favorite things. All these checks, but the valuation metrics are high. Now, again, this is part of my due diligence. It's part of my screener. So what this tells me now is, Paul, you love Apple's fundamentals. It's just a little overpriced right now. So what am I going to do? I'm going to add it to my watch list. I'm going to add it to my watch list on the software. And I'm going to say, you know what? I'm going to add notification. And it's currently at 160. When it goes below 120, notify me. Because at that point, it'll probably be somewhere in the ballpark of where I want to pay. And I'll just sit back and wait.
How much do you weigh a conference call, a quarterly conference call on the process of looking into a company? Because they're always very positive.
You know, it's a great question. Every value investor is different. Some of them really look at the conference calls, want to hear what the CEO is saying. As a CEO, I look at it more as a negative confirmation. If I think the CEO and the staff are being evasive and they're trying to avoid questions, to me, that's a confirmation of they're hiding something. I should avoid this. But if they're sitting there and saying, listen, if they speak like Warren Buffett, which is, hey, we had a tough quarter. Hey, we did great. I want to hear that. That's the only thing. What they actually say with their plans do matter. And I do listen to those and I do watch those, but only on companies I'm getting very close to buying. And it's only for red flags of, do I trust the CEO and this executive team? Do I trust those people? If
I gave you a list of 1,000 stocks to potentially invest in, how many would probably get into your wheelhouse?
Right, as this very second?
Yes.
Probably 20, 10 or 20. That's 1% to 2%. And guys, that's what you should be. There's 10,000 stocks out there. You just need to find 20 to 40 really awesome values. And if you find them, you will probably do very well if you find a good process. But going the due diligence route of those 5 things I said, plus that's a terrible way to go. You will lose money. And I just saw a study recently that showed how the average investor performs versus the market. If the market does 10% a year, and with your fund your financial planner and mutual funds doing 1 or 2% lower after fees, or before their fees, the average investor, because of mistiming and being emotional, makes about 2% per year in the last 20 years. That's what I read. That's crazy. So guys, create a process, figure it out, do the right due diligence, and cloud out all the noise. Get rid of the friends and family, get rid of the YouTube hypesters, find the YouTubers that have a good process. And if you like our process, Seth, what can they do next?
Watch this video on our full 8-pillar process.